This is episode 34 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 34 of the Andrew Hines Real Estate Investing Podcast. Today I have Mark Baltazar on the show, and Mark is a multifamily expert. He is somebody who started investing in multi just about a year and a half ago, but he's already managed to acquire himself a 14 unit and a 12 unit, and he's doing JVs on a massive scale. He's working on properties that are going to be worth $3 million, $3.2 million when he's done. We ran through a case study in today's episode. It's really inspiring what he's doing. Mark wants to demystify multifamily investing. He came on the show today to talk about the nuts and bolts to help people understand what goes into it so that they might be able to start to do this type of investing as well. If you're interested in scaling your business or growing to the next level or taking the next step, this is definitely an episode you're going to want to check out. So I really hope you enjoy this one. Without further ado, here's the episode with Mark Baltazar. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I have Mark Baltazar on the show. Mark, thanks for coming in.
Thank you for having me, and excited to have a conversation.
Yeah, me too, because you are pretty well exclusively into multifamily investing. Is that right?
I still do flips. So,
okay.
I started with flips maybe 4.5 years ago, 5 years ago, I guess now. And in fact, my intent was to start with wholesaling. And so the first deal that I got under contract ended up being a flip. And then a few years ago, and I accumulated some buy and holds along the way. And just through education and learning and networking and talking to people and mentors, multifamily kind of seemed like the path I needed to take just for goals and systemization and scale.
Okay, so Mark, let's just take a step back. What is it that you do for your 9 to 5, if you have one?
Yeah, so I do have a partial one. So about 15 years ago, I joined a really, really, really small marketing research company in Toronto. I was number 3, became a partner, so bought into the company, and we've grown that to we're about 30 now. But over the last couple of years, I've stepped back. It operates, my 2 other partners operate the day-to-day operations. I deal with some of the bigger clients still. But I've scaled back significantly to focus most of the time, almost full-time real estate.
Okay, so now take me through what you have done and where you started real estate investing wise.
Yeah, sure. So I guess that, my wife and I had always, we'd always been interested in real estate, wanted to get involved much sooner than we actually did. So procrastinated a little bit. But then, I'd say about 6 years ago or so, I started studying, reading books, listening to podcasts. And at that time, mostly, in fact, all American podcasts. There really weren't many Canadian podcasts about real estate investing in Canada. So, kudos to you to kind of bring Canadian content to the market, which is much needed. So I started learning about different strategies, and wholesaling kind of became one of those that, seemed to be, one I could grasp and potentially do on the side as a side business. And so, invested some money in marketing, signs, and did some digital marketing. Familiar with the digital marketing space, given my other business.
Okay.
And, for about 5 months or so was marketing, and I had some leads and would go see properties and make offers, and nothing would happen. So I was like, oh man, this doesn't work. This is just for the US. And then one Sunday afternoon got a call, and luckily enough, I think, that it was basically 2 minutes away from my primary resident. And, I went to go see the house, kind of reluctantly. I didn't really want to do it because I, had basically, I guess, failed maybe 20 times over the previous 5 months. And, long story short, they accepted my offer. And so,
was this a wholesale lead?
This was yeah. Okay. So that was the intent of this property.
Yeah.
And so I had a few, people in my network that I knew were investors and flippers. And so I approached one and said, listen, you want to buy this house? And he said, yeah, it seems like a good deal. But then he came back to me and said, why don't we partner on this as a flip? And, my response was, well, I don't know how to flip. I don't pick up a hammer, nor do I want to. But sure, let's see how it works out. I'll arrange the financing, the legal, we'll both put in money, and then see where it goes. So we ended up profiting on that one, handsomely, probably close to about $80K.
Where was that one?
That was in Brampton.
In Brampton, okay. Yeah. So just like a cosmetic reno, or?
Yeah. We spent maybe about $80,000. It was a full gut. Nothing. I mean, we took down some walls, opened the kitchen up. I mean, it's a model that consistent model that we run right now. So it's probably
just like a bungalow or something small.
Yeah, it was a two-story. Opened up the walls, made it look a little bit bigger, and then everything else was fairly cosmetic.
Okay.
So then it was okay. Well, this works. And then, I've done maybe 20 or so flips since then. Similar
to that, like similar scale and size of property?
Yeah. Most of them. I do have a project right now in Streetsville that started off as a tear down and rebuild, but we changed the strategy midway through to make it just more of an extensive renovation. So we're taking the roof off, putting extension on it. Permits are actually in the mail right now, so which is great.
So they're approved. They're mailing them to you?
Yeah, that's good. That was a fairly long process, but it is what it is. And so that's the biggest one I have going on right now. I had opportunities to get into similar ones, but I really want to get this large one done first, and then I'll do a few other development ones and on the side.
That's more still on the construction side.
Yeah.
So you said you've done about 20 flips though?
Yeah.
Okay, and you didn't want to keep these, do them as a BRRRR. You wanted to get rid of them?
So there were probably 3 along the way that I've kept.
Okay.
In fact, I recently sold 2 of them, primarily just to focus my attention on multifamily. So to take that capital, so I do put some of my own money into multifamily buildings. And so it was more to free up headspace and property management time, because I was managing it myself. At least my wife was managing the tenants.
Yeah.
And so we thought it was, best to liquidate, take some of that capital and just get ready for the next multifamily.
Yeah, and multifamily is where my head is at right now. I've been toying with it for many years and looking at on-market deals and feeling a little disappointed because I want to get in and BRRRR a multifamily. I don't want to buy and have all my money, and I want to find a creative way that I can pull that money back out and reuse it.
Yep.
And oftentimes I'm using private financing, expensive money.
Right.
Leaving it in is a cash negative option.
Yes.
Which is no good.
Yeah.
So I'm looking forward to getting down that little rabbit hole there as we talk about, even how you got started in it. I know you've talked about the flips now. When did you first invest in any real estate aside from your personal home?
I guess it was late 2015 or mid 2015.
Okay. And when did you buy your first multi?
That was early 2018.
Okay. So 20 flips between 2015 and now? Mm-hmm. You're doing well. Good work.
Yeah, I have a partner. So on flips, I do have same partner that I started with, 4.5 or so years ago. So same guy, that I'd known for, in fact, since high school. We kept in touch, but nothing quite formal.
Yeah.
I knew he was doing some stuff. I knew he was involved, with RAIN, Real Estate Investment Network. And that's so he was back in my mind. And so we still work on all of our projects together on the flip side of things.
Yeah, but not swinging a hammer. You guys are just working them as in buying, selling.
That's right. Yeah. So the arrangement we have is, I deal with the financing. We raise capital for all of our projects. So our projects are financed through JV partners. So a JV partner structure with our flips.
Okay. So you guys represent one side of the partnership, and then you guys bring in a money partner as well.
Right. Yeah.
Okay.
Yeah.
And you'll both find leads for that.
Yeah. I mean, that's primarily kind of the responsibility that I've taken on is find private, typically private, sellers, whether it's through wholesaler or I do some of my own marketing still. And then he manages the construction.
You said you find private sellers. You're finding private wholesale deals?
Yep. Yeah. Okay. So I buy off wholesalers.
So you know Luke then?
Yes. I bought 2 off him recently.
Everybody knows Luke.
Yeah. Yeah.
He's going to get a lot of shouts out on this,
good
podcast.
Yeah.
Okay, so you're finding the deals. With the 3-way joint venture, do you not find that can kind of be too many hands in the cookie jar, so to speak?
I think it can be. It all depends on how you structure it up front, right? So, I'm pretty clear with my joint venture partners that, we're running the show in terms of myself and my partner. So here's the model. The model is, we're get a house. We know what the design is going to be. We know what the colors are going to be, and let us run our model. And if you're interested in that, if you put money in this project, then you'll likely get returns of X, right? Depending on what project it is.
Okay. So are you giving them like say 33% stake, or do they get 50% stake, or is it something alternative to both of those options?
So on the flips, they get 50%. So they get 50%. Sometimes, there's multiple money partners that get involved, depending on the size of the project. So they get a 50% stake for buying into the project. And their responsibility is really capital. And, I update them on a frequent basis, but at no time do they have a say in colors, design, etc. But they know that up front.
Silent partner.
Now, I in one of my flips, that wasn't the case. And it just turned, there's just a lot of, I think, wasted energy on, where the couch is going to go for staging, what color the room is going to be, et cetera, et cetera. And that's just not, we're running, the proposition of my company, Peak Property Investments, is it's hands-free, right? So if you're interested in generating return hands-free, then we're a solution for that.
Yeah. Otherwise it's not the right one.
That's right. Yeah.
Okay. And give me an example of your average deal. Like what are you going after?
For flips?
Yeah.
So it ranges, I have one going on in just outside of St. Catharines. That purchase was about $260,000.
Okay.
We'll look to turn that around. That'll be probably a 7 or 8 month project, maybe 9 with permits. And, we're targeting about 500,000. And so it'll profit about 80, let's say.
Okay. So $500,000 renovation and acquisition total, or
so ARV will be 500 to 550 or so.
Yeah.
So say 260, we're probably going to spend about 120 on it.
Okay.
So now we're in for 380 plus financing costs, etc. Minus agent fees, etc. So we're looking at the 80 to 100,000 range on that one.
Okay.
Some are a little bit smaller, some are 40,000. But we try to keep above 60 just to make it worth our while. In fact, we're now considering not doing anything that's smaller than 60 or even
60
70,000.
target profit.
And
now when you say 60 is your target, is 60 a worst case, or 60 is your actual middle? That's the middle of the road.
I'd say middle. We've done stuff that's lower than that.
It ends up lower even though you thought it was better?
We've taken on lower just to keep busy.
Right. Okay. Really. So when you say 60, track record suggests that you're pretty accurate with that.
Yeah. The only from predicting an ARV, we've been pretty good at that. Similar to how I underwrite multifamily buildings, I'm pretty conservative on the flip ARV. So it's ends up being pretty close. So it's a conservative estimate, and if anything, we'll surpass that, and it's a bonus to ourselves and our investors.
So on a yearly basis, what are you guys, about 10 projects or 8 projects?
I'd say about 8.
8 projects.
Flips. Yeah.
Okay, so we're gonna crunch some rough numbers here.
Yeah.
Okay, so about 60,000 is kind of now the cutoff.
Yeah.
80 a year, and I'm just gonna crunch I shouldn't be doing a calculator for this, but I'll do it anyway. So 480,000 gross profit to be split between you and your joint venture partners. So you and your main partner are roughly taking half of that to split amongst the two. So you guys have about 240 there, which you can split. So not bad while you're able to do other stuff and still work your job.
Yeah, absolutely.
Yeah. Okay. So why don't we go ahead and get in and talk about the multifamily? Because before we got on record here, you mentioned demystifying multifamily investing, and I think that's a great way of putting it. So why don't we demystify it?
Sure.
You bought in 2018. I know that's not that long ago, but you've probably learned a heck of a lot in that time frame.
Yeah. So a couple of things. So one, bought a 14 unit. Have a partner on that who also has others as well. So collectively, the portfolio is larger than that in terms of brain power, and we have access to friends that have significantly larger portfolios, which we lean on a consistent basis. But I think I held back because of the size, on the building size, just the management size, but also the amount of capital needed at first. But I think when you look at, how it can be done and the financing terms and how banks value properties like that, it's not. I think it's not as hard as people may think at first. Not to say that it's easy. Anything kind of worth having does take a little bit of work, but it's anyone can do it. I think anyone can do it.
Okay.
If you have a mentor, a little bit of experience, I think anyone can get into multifamily.
So you mentioned you had friends that were doing, larger portfolios of multis, which I think is so critical, right? Everyone who gets started seems to have a story of someone they met or some story they heard. The odd person did it all on their own, but it's a lot more rare. Where did these friends come from? Are they from work or school or?
Yeah. So my two partners on the first deal, very close friends of them. They have, they run essentially a REIT, so about $100 million portfolio. And they're no longer, buying things that are 10 to 20 units. They're buying things that are much larger than that. Okay. And so deals that we would underwrite, he would take a look at and, give us some tips and, make some suggestions. Okay. And so that was very helpful. I spent some time educating myself, in the beginning, spent some time with Pierre-Paul Turgeon, still communicate with him on a regular basis on the phone and through email. So he's been, helpful as well. So I think having a mentor, and having someone to, that you can just ask quick questions, online courses and books, etc. Those are all good. Podcasts are good too, but there's sometimes there's specific details that, of a deal that
you want to ask.
You just need to ask, right? So I've been fortunate enough to have those people around me that I can tap into.
Now, to clarify, when you say underwrite, this is when you're evaluating deals that you're thinking about buying.
Yeah. So figuring out, does the financial model work? Yeah. The model that we run in the buildings that we're continuing to look at today are ones that require significant, value add. So they're run down, they're undermanaged, they're financially performing poorly today. And our plan is to turn that around. So it's essentially like buying a underperforming business and turning that around.
Okay, so right now you're on one multi, or you have others in the works, or
so there's two. Yeah, so we have two 7s and a 12, so 3 buildings in the portfolio. Yeah, and we've been pretty active over the last 2 months. We've probably just yesterday I went to go see 2, last week 2. So it is a hot market. So similar to flips, what we're finding is once a building gets onto the MLS or the public market, it either goes pretty quick or it's been passed over already by many investors. So what we've been focusing our time on is private leads and direct to seller or direct to broker.
So you're mailing people or?
Yeah. So my partner has a process that he's kind of been following to get that. And so sometimes it's direct, of the last 5, let's say 3 of them were direct to, the owner. And typically they're older European owners that, they're in their 80s now and just they bought, 40 years ago. And they're just, they're done. They're time to retire. And so, that's who we're targeting. And typically those owners haven't kept up with rental increases. The buildings are in decent condition, but there's improvements to be made. So it's perfect. It's our sweet spot. And we're looking at the 20 unit size.
So 20 units, kind of what you're targeting now. Yeah. All right. Where are the properties? You have a 7, and a 12.
Hamilton. They're all in Hamilton.
They're all in Hamilton. Are you still only looking in Hamilton?
Yeah, right now that's where our focus has been. That's where, over the last 2 months, those are really the only properties we've looked at. Actually, no, we've gone to St. Catharines and we've gone to Welland. The markets there they're decent, but we know that the Hamilton market is super strong from a whole number of aspects. Rental demand is super strong, growing at 14% per year. One of the top rental markets in Canada. There's a lot of infrastructure development. So the light rail transit's going through there. In fact, so there's a lot of stuff that's happening that creates this, protective barrier around this investment.
There's a lot of, definitely economic reasons to be there and economic reasons for growth in the future, which I certainly like. I think St. Catharines and Welland also have their potential, but I think Hamilton is more instantaneous.
Absolutely. Yeah.
Okay. So,
and it's competitive. I mean, because of that, it's very competitive.
So not to kind of breeze past the approaching sellers on multis, because I think that in my head has seemed like this crazy hurdle. What are some strategies that you have seen work for approaching these sellers? I mean, that's probably a lot of roll up your sleeves and do whatever it takes.
So it's not as quick as single family.
Okay.
It's been a lot of letters to sellers.
So will you send? So how are you finding their mailing addresses? Because obviously it's not unit 1 at the property. Yeah.
So there's so it's digging through. So looking at an area.
Okay.
Looking at basically walking down a street, looking at the addresses. You can go to tax roll departments.
I've done that before.
So doing that kind of work. So going beyond the surface. So I think this is where the nitty gritty and rolling up your sleeves work comes into play.
So you go to tax roll, you write down the owner's name, and you actually craft a letter and say, hey, I saw your building. I am interested. I was wondering if you'd like to chat.
And sometimes, you'll get, it's a conversion rate, right?
Yeah. What do you think's reasonable on something like that? I mean, it just seems like so much work per letter, but I mean, certainly because it's personally addressed, it's more likely to convert than a non-addressed letter.
Yeah, absolutely. And if you get, and so we're just starting this now. So in terms of knowing what a good conversion is, not sure. But if you get one or two like that per year, in terms of deals closed, then that's good. I think for us, that's good. I mean, if we can close on, 220s a year, then that becomes a worthwhile exercise.
Okay. So you're still too early to know what your conversion rate on that would be. Yeah. What are some of the things you've done that have worked for finding privates? Is it just networking? Yeah,
networking. So prior to going to direct to owner, so wholesalers. So there are some that deal specifically in commercial. Haven't bought one from a wholesaler, but see a lot of leads. And then brokers. I think networking events, brokers, oftentimes, they'll sell direct before going to public. Commercial agents. So I have seen leads, so off-market leads come from brokers as well as commercial agents.
Agents. Okay. So when you're differentiating, like you're saying a real estate broker versus an agent, very few people would differentiate between that.
I think someone who runs the office
is more
who has a direct contact with, and so some of the bigger outfits as well, so colliers, some of the more CBRE.
Yeah.
Right. So those guys, they deal with larger ones, larger properties. So the 30, 40 plus, but sometimes they'll come across a 10 and a 20, which is kind of our sweet spot right now. And so as long as they know that, we're looking for that, then we'll get it. So we've had a few passed along from some of these bigger outfits.
What kind of cap rates are you, out of the three you've been able to acquire to date, what kind of cap rates are you buying them at? And then we'll go over potential as a second question.
Sure. So the 2018 one, that was bought at a 4.75 cap. The one in 2014, which is my partner kind of brought into the portfolio, that was closer to 6. That's in Hamilton.
That was this year? Sorry.
That was in 2014.
2014. Oh, okay. So you've had that one for a while.
So my partner in multifamily, he had that one already. So that's kind of part of the portfolio.
So now you guys have built that in. You've merged that. Okay. So that was back in, a different time, I guess.
Time. Yeah. That was when it was, I think 70,000 to 75,000 a door. Right.
Yeah.
So
what are you seeing per door now?
So I went to go look at two yesterday. One was 33,000 a door. One was 133,000 a door. One was $140,000 a door. So that's the range. I think that's the tip. It depends on the configuration, but 1 to 2 bedroom is basically, that's what you're going to see.
You're over 100 a door now. You're like 120 plus.
Yeah. I went to go see one last week and that was 100 a door. But it's in a different area of Hamilton. It's in, hasn't been gentrified yet. It's kind of Barton, if you're familiar with the area.
Yeah.
So, a little rougher part of town. You can get it at 100,000 a door. So there are, places that you can still buy, but it depends on, again, not as close to transit, but if you're closer to transit, you're looking at 140 a door.
Yikes. Like, and you mean closer to the GO transit or closer to just a bus stop?
So downtown, we looked at one that was about 145,000 a door, which is right downtown, walking distance to, all the amenities, basically downtown. Again, pretty rough shape, structurally okay, but needs new windows, needs, common area refreshing. All the units needed to be, redone, but you're still paying $145,000 a door. But again, if you're holding it for 7 years, even sometimes 10, it's worth overpaying now. At least we think anyways, it's worth overpaying now because once these are average rents of about $700, $750 a door.
Right.
We know that it should be $1,500 a door, $1,550 a door.
Really?
So
downtown.
Downtown.
But not like, trying to think of another example, like more east.
So like say Main Street East.
Yeah.
Right. So When I underwrote the one purchased in 2018, my estimate so it would work. The financial model would work if we got 1175 for a one bedroom.
Okay.
We got 1400 in April 1st
For a one bedroom?
for a one bedroom.
How many units did you get that on?
So it's our first one. So there's our first renovation. So now we're turning over the
So
other
you're gonna
ones.
keep going.
Yep.
So that's the model. You have everybody in there, cash flows continue. Now we have so many questions. When you buy, the money that's coming in, is that as an equity position for the down payment? Is that equity position for whoever's providing it? Is that a joint venture partner that's providing it?
Yes. So it's a JV. It's a standard JV.
So it's still you and your main partner,
Yep.
JV with somebody else.
Yep.
Okay.
Yeah. So we are looking at different models though, because one of the common questions that we do get from joint venture partners is just liability, right? So another, at that, level of capital invested. So we're dealing with investors that are putting 100, sometimes 200,000 of investors putting 400, they want a little bit more protection. And so looking at LLPs as a kind of a way to structure the deals to protect our joint venture partners or
Like their
investors.
interest in it?
Yeah, because with a joint venture, a joint venture partner, your liability there's no limit to the liability, right? So if the building loses, you can lose more than what you put in. Now, I think in real estate and in Hamilton, the market, that's very unlikely to happen.
Far-fetched.
Yeah.
What would have to happen for that to be a
Well,
case?
we get that question,
Yeah.
right? We get that question a lot. And often it's a disaster or extreme mismanagement, but there's insurance that protects
Well, yeah,
them
exactly.
against
You
that.
have insurance, unless your insurance company goes bankrupt. But
Yeah.
that'd probably be your biggest worry if you have a disaster. Now, some insurance policies exclude certain events, like an earthquake. You want to make sure that earthquake, flood, are those things going to take down your building? But even if those things were true, I guess that's pretty ugly. But I mean, there is a recovery, and that city is still great, and it's not. It's likely an isolated incident, so the land will still have value. But that'd be ugly, for sure.
So in fact, it's a question that we get.
Yeah.
That's probably the most common question.
But if that happens, things are going to shit anyway.
Yeah. That's right. Yeah.
Yeah. So, I mean, I guess if you're at that point, I mean, well, I guess we're kind of all screwed if that happens.
Yeah.
So,
Yeah.
I kind of have that response for people too. Sometimes it's, it's not as simple as it may seem.
Yeah.
So you've started to turn over your unit, and you're going to do more of that. And is that on the 7 unit or the other one?
So the two 7s are actually side by side. So the plan really wasn't to get anything or get into a 7, given its size, because the whole point was to scale.
To get bigger. Okay, so that's 14.
Yeah.
So you basically have a 14.
They're right beside each other. They're the exact same configuration. So the layouts are the exact same. Essentially, they're identical buildings.
Yep.
So there's 2 more that are kind of up for renovation in September.
And that's out of those buildings.
That's out of those buildings.
And those are, you said, more like east end towards
Main Street East. Yeah.
Yeah.
Okay. It's about, and so I didn't factor this into my financial model, but the LRT stop is about 50 meters from it. And so that will give a nice, boost.
So that's just bonus.
Bonus.
When's that scheduled?
I think they're scheduling 4 years.
4 years.
So give or take a couple years, right?
Yeah.
So that's why I didn't really want to put it in. It performs well without that assumption.
Hamilton's going to be such an interesting place to see. I mean, there's still such horrid areas that I don't know how they'll ever make them look good. But I mean, in Toronto, they kind of made it look cool, past Queen West, like Dundas on, further west. There's some pretty rough areas that they've turned hipster.
Yeah, totally.
Hipster, kind of a little greasy is cool.
Yeah. And I think, it's Hamilton's on a 20-year plus trajectory, right? So, I mean, the way I think about it, it's like, it's the next Toronto, right? There's really nothing like it.
It is.
Outside of Toronto.
Right. So Toronto's where you drop the rock and the ripples keep traveling out, and then they're not going to stop. And Hamilton's got a bright future. It's been very delayed by just how rough it was.
Yes.
And still is.
Yeah. Yes.
But it's coming along. The cat's kind of out of the bag with Hamilton for sure.
Absolutely.
So why don't we walk through some of the numbers as to how you make this work? So you have an equity partner. That's nice. So they're coming in with 25% down plus reno cost. Or are they just bringing in 25%? How are you structuring it?
So basically, 100%. So 100% of the capital required is brought in by investors.
Okay.
Now, I also have capital in as well. And again, it helps with the question. what if things go south, right? Well, my interest, aside from just having an equity share and sweat equity, as you can call it, I also have financial, stake in it. And so the capital that we raise goes for the down payment as well as renovation.
Okay. So in this one, what's the purchase price? So say the two 7s that are side by side, we'll call it a 14.
Yep. There's 1.7.
1.7 all in?
Yep.
What was your mortgage on that one?
So we had a 65% LTV.
Okay.
So for this one, again, similar to BRRRR strategy in that it's, so we have some bridge financing that we have for 2 years to allow us to, renovate and, increase net operating income.
Oh, did they do like a purchase plus improvements? Like they give you?
No, we did a 2-year term, term with a B lender.
Oh, okay. Just at 65%.
Yeah. 65% LTV, 5.25%, which isn't too bad. And then, at month 24, we'll refi with an A lender and maybe go CMHC.
Yeah. That's where it kind of starts to pay like gravy, but it all happens so slow.
Yes.
Yeah.
Yes.
B lender, is that our favorite Home Trust, or is that somebody else?
Yeah, we use Home Trust.
Yeah, they're getting kind of bigger into that space. I hear that answer a lot. They're everywhere.
Yeah, we stayed away from them for a bit, given when they had their issues, just because we were pulling out of deals at the last minute. But yeah, it worked. I mean, we looked at a few lenders. They came back with terms, and we negotiated some terms that made sense for the deal.
Okay, so we'll call that your net investment. I know that you technically would have some legals on top of that. So your $595 down payment, you'd probably be another $50,000 on top of that to close the deal. Or
in terms of fees. Legals are probably about $5,000, and then some financing costs. So we used a broker, so there's some financing costs on that. Yeah, of about $11,000, I think it was.
11,000.
Yeah. Yeah.
And
then we
had
land transfer. Then we had an inspector. So go through 2 buildings. That was about $3,500 or so.
Oh, like an engineer or somebody who's certified. So land transfer, I'm trying to think of what you would have been. You would have been like, what,
1.42% ish. So whatever that is.
You would have been so 25,000. And then you would have been your inspector of 3,500. It's just good to kind of dig into some of these numbers because the people who haven't done it,
totally,
it's mystified.
That's right. That's right. Yeah.
Okay, so those, we'll call them closing costs, which is what they are. Let's just total those up, and that's just from what we can remember right now. That's about 44,500. So I wasn't off with my 50. So closing, so total investment initially was the 595 plus the 44.5. So you're at 639,500, of which your investors brought in how much?
So we raised 875.
Okay.
Yeah, and so we buffered in from renovation costs.
So then you got some reno costs in there. Okay.
Yeah. And so renos about 28,000 a unit.
Okay.
So which is higher than typical for a unit like this. But done purposely to attract the higher rents. So, a couple of things that we've done. Everything's brand new. So everything's completely gutted, vinyl flooring, brand new kitchen, quartz countertops, stainless steel appliances.
And this is King Street East.
It is Main Street. Yeah, Main Street East.
Sorry.
Yeah, Main Street East. Yeah. So turned into Main. In-suite laundry. Okay. So the buildings do have common area laundry, but we're converting the units, right? So you get super clean. We staged the first one just so we have some marketing material for the other ones, because again, the configuration is exactly the same. There's I guess 12 1-bedrooms and 2 2s. So we spent a little more in air conditioning. So put AC in there.
You put AC units in individual units. So like the ductless mini split things with a heat pump, or just air conditioning?
Just air conditioning.
Yeah. And then you have centralized boiler system for the building.
Yeah.
these are all the things that in my head, when I'm wanting to do a property and on a micro scale, I'm like, how do I make it great? I don't want it to be like, oh, but I wish it had this. I'm like, no, I want it to have that. I just realized that I didn't connect water lines on the fridges on one of my student rentals to the ice thing. And the student just texted me. And I'm like, no.
Oh yeah, that thing.
Way too late now.
We've forgotten them on flips. This one's in. Like we put this one.
You put them in on this one. Yeah. It's such a little like meaningless thing, but it means something to the person.
Totally.
So the valuation at the time, you said, did you give me a cap rate on this building?
This one was bought at 4.75.
So 4.75. So for those who aren't familiar with cap rates right now, that basically means the operating income divided by 4.75%.
Yes.
Would yield or give you your purchase price.
Yeah. So I think we were at 82-ish.
Okay.
82,000.
So
NOI.
Okay, so I see 80,750. So it wouldn't have been maybe exactly 4.75.
Yeah.
But let's just say it was 4.75. So if that holds true, here's where it gets really easy for us as investors working with cap rates. Yeah. What do you think you can increase your operating income to when you get all the units?
Yeah, so projected will probably we'll be close to double. So we're on track. So when I underwrite, I have a low estimate, a moderate estimate, and a high estimate. We'll buy and we'll go look at property if kind of on paper it does about 30% the property. So this one
30% on the actual investment.
Yeah,
on the net actual investment. So what we're calculating, we calculated 639,000, but you said you guys had raised 875.
Yeah.
So on that 875, you want 30%.
So 15%. So 30% of the on the whole property, at least somewhere between 12 and 15% for the investor.
Okay, so they get 12 to 15%.
Yeah.
And then you guys, you get a lot more because you did sweat equity.
Yeah. So we'll go look at a property if it hits that, and then we'll crunch our numbers even further.
Okay.
This one is on track right now to do. We're probably in the 20-ish range, given that we just rented or in April rented the one bedroom for $1,400.
So 20% return?
Yes.
So you'll be 10% to the investor and then...
No, 20 for the investor.
Oh, 20. Wow.
So the property will do 40.
Spoiling them.
Yeah. So it's good. I mean, again, I think it's a function of conservative underwriting at first.
Yeah.
But also just how hot the market is. Again, we were given the network of people around us that have properties in the area as well, we were pretty confident that 1175 was a good number for one bedroom.
Okay.
But because the market's been so hot and there's such low supply, high demand, at 1400, I mean, we actually had, in fact, we listed it at 1350 and then we had multiple people wanting it, so bumped it up to 1400.
Oh, really? See, that's another conversation. So when you got the responses, prices changed because of demand.
Yeah.
Is that all you said?
Yeah. Yeah, I mean,
it's nice to just be upfront. Hey, man, I got way too many responses. We're increasing the price.
I've done it a couple times, and I'm open with them. And say, if you want it, here's and sometimes the tenant or prospective tenant will offer more, and then I'll just be fair to the other. Once I narrowed it down to a few. Also, which we didn't factor into our original estimates as well, is this new tenant is paying for parking as well. So none of the other tenants are paying for parking. So we're charging $30 per spot. On. So that's an extra 2 spots that they have. So it's $1,460 essentially that tenant's bringing in.
Very nice. Okay, so what I've got so far here is new operating income. You said it's about double. So for simplicity, 160,000 at 4.75 cap. If we just divide that out, that works out to 3.368 million.
Yeah.
So what I want to do now is if you were to go 65% on that, maybe we figure out what your BRRRR is.
Yeah.
See, this is a big BRRRR.
Sure.
This is a big BRRRR. Okay, so if we did 65% of that, your new mortgage is 65% works out to be about 2.18 million. And the perfect BRRRR is when you can pull all your money back out and maybe even a little extra. That's cool. So what will you have into it at that point? Once you're all done the renos, so we calculated your initial investment just to close it was 639.5. Okay, and then you had renovations of 28,000 a unit.
So total at that time, So let's say in 5 years, assuming we do 100%, so 14 units by 28, the refi, so refi at year 2, right? So we refi at year 2.
So it wouldn't be as clean as what we're trying to do here.
So the reason why we didn't have to raise $1 million, something like this, so if you were to go, so not refi until year 5, then we'd raise way more. But the benefit to
you can recycle the money.
That's right. So we're raising less, and then year 2 pull out and then continue on. That's right. And so that money will fund the remaining 4 5 units that haven't been done.
So it's not going to completely change our numbers if we do this. Basically, I'm just looking at getting at what is the total amount we're in from the investment. So your initial purchase was 1.7 million. Your renovations were 392,000, and then your closing costs equal to 44,500. Yeah. So those are basically the costs to acquire and improve the building.
So our projection is that there's about a 1.1 million on the table profit
of equity in there.
Of net profit.
I have the initial purchase at 1.7. You were renovations of 392 and your closing costs of 44.5. Now, of course, if you're refinancing, there are extra costs in there that would be added on. So if we wanted to keep it real simple here, then our total cost to acquire and improve the building would be about 2.13 million. Mm-hmm. And your new mortgage is about 2.189. So we're almost a complete wash according to these numbers. Now I know you had some extra fees. Yeah. So acquire and improve 2.136. Yeah. And then if we subtract off your new mortgage, you guys are going to get $52,000 back if that all goes as planned. So this is the perfect BRRRR, the one that actually pays you. You can acquire it and you're in with zero. The bank has totally financed it. And now not only are you in with zero, but you also have equity that you've created. In the ballpark of over $1 million. Yeah. And if you go CMHC on your financing, you can pull out 85. Like I did this mortgage at 65%. Right. You guys could potentially be pulling out hundreds of thousands of dollars to put back into new projects. Yeah.
Hey guys, let's just pause the episode for a second and hear from our sponsors.
Today's episode is brought to you by the Real Estate Growth Summit, hosted in Toronto, Ontario at the Pearson Convention Center on November 11th and 12th. I have Dylan here to talk to you about the things that you're going to learn at the Real Estate Growth Summit. Dylan, take it away.
Thanks, Andrew. Really excited to be sponsors of your podcast. This event is for listeners like you that want to take your real estate sales or real estate investing business to the next level and to replace your active income with passive income through learning and implementing the systems and processes used by the best in the industry. Be prepared to walk away with some tangible tools and an action plan that I have personally used to become a top performer in the industry in just under 3 years. To get your tickets before prices go up, visit www.realestategrowthsummit.ca. And for being loyal listeners of Andrew's podcast, there's a special discount code just for you. All you have to do is enter Andrew REI as the promo code at checkout to save $50 off admission. The only way you're ever going to reach your massive goals is to take massive action. So go get your tickets today and we'll see you at the event.
Okay, let's get back to the episode.
Like get all the investors' money back and get into new projects. So if you're at that 4.75 cap on a $3.3 million building, all your units are rented out at 1,400 or more. Yeah. What do you figure your cash flow on that building is going to be?
So in year 2, so year 24, so I look at it in 2 phases. Phase 1, which is up to 24, and then refi, and then afterwards.
But I'm saying once it's all done, like once it's all units are renovated.
Yeah. So once it's all done, so the plan really is to sell it, right?
Oh, so, it is.
Yeah. So there's 3 exit strategies, but the plan right now on paper is to sell it. The other plan, which we'd have to get consensus from the partners, because it would be different than what the original plan would be to refi and just hold it, get everyone's money back. But so far, there's the investors that are on board would be in for that. The third strategy, and this one's unique for this specific property. So again, they're side by side. So the Ontario Planning Act states that if you buy 2 properties side by side under the same owner, they automatically merge into one piece, right? So these ones purposely were bought with 2 separate kind of quote unquote owners, right? It's a number of companies. So one strategy may also be to sell one and get our money out and then keep the other one for no cash in.
Seems like you could just refi and do the same thing. Yeah. So it looks like you guys are ripe with options here. Yeah. A million different things you could do. I'm curious what your cash flow would be on the on a 4.75 cap with a proper mortgage.
Mm-hmm.
If you went CMHC and you did like a 40-year mortgage, I'm trying to think of what you would get on cash flow there. Did you have any?
Yeah. It doesn't come to mind right now. It was strong. And so for our partners, we would basically keep 25% of the cash flow in the property and then pay out as a distribution 75% of what's the net cash flow. Top of mind, I can't remember what that number is. There wouldn't be much cash flow to pay out until probably month 25, month 26.
Yeah, I guess I'm more going into that ideal world. Once you're all done, everything. I would have to assume you'd be making probably $500 a door.
Yeah.
So say you were making $500 a door times 14, you're going to be $7,000 a month cash flow after your taxes and your mortgage payment. And you're going to have no money in, so your return is infinite. I mean, we couldn't even calculate it. It would be bonkers if we could. But the scale of what you're doing, I mean, if you could find a way to just acquire these and, own half of 20 buildings like this, I mean, that makes for a very pretty early retirement, as soon as you can kind of pull it off.
And that's kind of the light bulb went off, when I had, have a fourplex and a duplex. And then I looked at these kind of numbers and just the scale and the amount of work, involved. It's not that much more. It was a little bit more because, again, you're dealing with multiple units.
And more people. That's probably the biggest concern I think a lot of people have.
Yeah, more people. Yeah.
How do you cope with that, and what systems have you set up to be able to transition these tenants out so that you can renovate these units?
Yeah, so right now, for this one, we are managing it ourselves. So myself and my partners, in terms of property management day to day, purposely, so that we just get a better feel of the building, how it's operating, and the tenants. So right now, we've basically talked to all tenants just to feel them out, what their plans are. Two of them right away. I said, we understand that you're, renovating and, happy to go. Which is great. There is a plan in place to, cash for keys at some point and figure out what that number is. And we know what that number is based on the cap rate and based on the calculation that you just did. So there's an ROI to that.
There's a payback, right? Like how quick do you need it to pay back? Do you have a thought in mind?
You know what? We'll explore that once we don't have any more units to renovate, right? So if there's some natural turnover, which there is right now, so we have the next probably 3 units that are natural. So 4 will be just natural turnover. Yeah. At that point, we need to get to our 7 or 8 is their magic number for a refi. If it's not coming fast enough, then we'll have to explore some of these other options. More.
Yeah, I mean, it all depends. Like to me, when I looked at these projects, I'm like, well, if I'm paying, 10% or what have you on the money and, on my down payment money, plus I'm paying my mortgage and I'm cash negative and every month hurts. It's like that's probably the number one reason I didn't pursue large multi. Yeah. Because it just daunted me. I'm like, well, what if I have issues with tenants, aren't able to get them out? I don't love that plan. That's why I kind of like what you're doing, where you're offering more of a target return to your investors. You're saying you're in it with us, but we're going to do everything. Yeah. And, you got to just set it and forget it with this money. Yeah. But when it pays off, it's going to be worth your while. Absolutely. And then you don't put that gun to your head where you're cash negative from day one. It's losing money. You're having to find a way or scramble. And that just, you want to enjoy life, right? You don't want to have to be like every day stressing that I got to get this done. So key, structure the deal the right way. Yeah, absolutely. I mean,
this building was cash flow negative upon acquisition. There was actually 2 vacant units, and we put someone in right away, again, just to protect ourselves into one of the units and renovated the other ones. Looking back, I wish we just would have renovated the 2.
Yeah, never put them in with landlord tenant act. Your options are so limited. If you get somebody who wants to stay, I mean, most people are reasonable. And if you say, hey, we want to renovate your unit, it's going to disturb you. We don't want to do that. Is there a circumstance where you would consider moving on? Yeah. And just start the conversation. Yeah. And say, oh no, we never want to leave. And I'm like, okay, well, fair enough. If it were to happen though, because we're going to renovate anyway, we don't want to displace you. Yeah. Perhaps we can work it out where it's a win-win, right? Because you can definitely make them leave to renovate. Yeah. It's just they have to get an option to come back.
That's right.
Which is like, well, I mean, are they really? What if the renovation takes 6 months, right? So I think there's ways to talk through that with reasonable people.
Yeah. So you know what? So far, the people that are on deck to leave, they understand, they get it, and it's been fairly pleasant in terms of conversation.
So out of 14, how many have turned over?
So one's turned over officially. So we have new tenants in one, and we have 3 more on deck right now.
Okay, so they've given notice?
Yes.
Okay, so you've got a 60-day notice on them?
Yeah.
Okay, and then have you had further conversations?
Beyond those, no, because we want to get
these people have just kind of shown that they're interested in leaving, and you've pursued that.
Yeah, and we'll do the 2 at once, and then the third one will hopefully happen before the end of the year. So we'll have 4 done by the end of the year, and then once those are done, get new tenants, then we'll pursue the other ones.
What's your comfort zone with renovations? Like, how many do you feel you have capacity to do at one time?
So what's interesting is that, again, because of the network that we have, the construction team that we've used for the first one and we'll use for the other ones is used to doing like 150 units a year of these types of renovations.
So you can do whatever you want.
Yeah. So they have the capacity to do a lot.
Okay.
So for us, it's pretty hands-free.
So mostly 1-bed units or 2-bed?
So there's 12 ones to 2s.
12 ones, 2 2s. Okay. And you turned over a 2.
1.
Oh, you turned over a 1 for 14. So your 2s will go for even more.
Yeah.
Okay. And what are you getting done for $28,000 per unit?
So it's a complete gut. So this specific property, the units, the 1-bedrooms are 520 square feet approximately.
520 1-beds. Okay.
Yeah. Pretty open. We're taking down a wall or as much as we can without impeding on or infringing upon the electrical panel.
Okay.
So opening it up, vinyl flooring, brand new vinyl flooring, brand new kitchen, so custom cabinetry, quartz countertop, so that gives it a little bit of a kind of a luxury feel.
Oh, absolutely.
Stainless steel appliances, in-suite laundry. So these units there's not enough room for stackables, so we have the 2-in-1.
2-in-1?
Yeah, so they're pretty popular in Europe. They're starting to come here. So basically it's a washer and dryer in one unit.
That is cool.
Yeah. So
very cool.
They're a little more expensive. They're about $1,350.
That's not bad.
It's not bad. It takes a little bit longer to dry your clothes because it's a 2-in-1, so it's not built for just drying. So but again, in this specific building, our tenants are paying for hydro. So they can manage what how long it takes them to dry, right?
Yeah. People don't ask that question when they move in. Well, how much are you? I mean, they do, but I don't think it's like a deal maker.
No.
Right?
I mean, these are efficient units. It just takes a little bit longer than a typical dryer. What else did we put in there? AC.
So you got the AC. I think you had mentioned most of these before, but I just wanted to recap it. So you've got AC, new baseboard trim, or you just left what was there?
No, everything's new. So new baseboard trim.
Okay. So new wiring in the units?
No, we didn't have to do much actually. Okay. We didn't have to do much.
Just whatever as needed. You did it
as needed. Again, new bathrooms.
So tile surround, toilet, tile on the floor, vanity.
Yeah.
So that's a pretty efficient renovation if you're buying in bulk.
We didn't do tile in the bathrooms. Actually, we went straight through with vinyl.
Oh, with vinyl. Yeah, I like that. I'm a fan of that on my properties, my student rentals. Vinyl on the floor. I'll still do tile around the tub. Yeah. But I do the waterproof vinyl, and it's great. I like it, and it's so much easier because I don't like the step in construction where you have to bring in the tile guy to do the floor, because that just holds people up for. So literally, it's a scheduling decision for me to not do tile on the floor.
Yeah, it makes sense. It
just speeds you along, right?
Yeah, absolutely.
What is something that you've discovered along your way that you're confident that most people don't know about this game that you'd like for them to know?
On the financing side, so I think there's a myth. I think it's a common myth. I'm not sure. You can tell me if you've heard this from other investors that are looking to get into multifamily or people talking about multifamily, is that, it's 100% about how the building performs, and financing is just based on the building and not your personal income or net worth, which is not true. So as the sponsor or guarantor of the mortgage, they do look at your net worth. Yes. Right. So what I think a lot of people believe is that commercial buildings, it's just 100% about the property, which is mostly true. If you don't have the net worth, then partner with someone that has the net worth. Their net worth needs to be, a significant proportion or a proportion of the mortgage amount. So I think, while financing might be a little bit easier, you do still have to, show your own financials and have, some net worth to support the mortgage that you're taking on, because they're not just going to lend to anybody. Also, experience matters. So not just multifamily experience, but experience in managing teams or business experience. Banks look at that, or perhaps experience in managing other units, rental units. That's important. So I think it's a different financing game, but they do look at the person that's running or the people that are running the property.
Yeah, I can speak to like when I used to do these. I actually used to do some commercial mortgage underwriting as an agent working for a brokerage. I remember the stacks, the files that I would send in for the commercial deals were, could be 5 inches thick.
Right.
Where a residential file would be, 1/8 of an inch.
Yep.
It really is an intense game. They do ask for a lot. The myth, I guess, quote unquote, and it's not a myth that it is mostly about the building. It is mostly about the building in the sense that you're not getting evaluated with a debt coverage ratio personally.
Yes.
They're looking at the building's ability to sustain itself. And then of course they want to know that you've got good income personally. They want to know you've got good credit personally, and then good net worth, of course. Now, I don't know if I've ever heard a specific amount of net worth that they're looking for, but I do know that they ask for it. And I haven't heard. It's been a long time since I've underwritten one. I don't recall ever hearing no, other than maybe one person. But most people, if the net worth reasonably makes sense, you can usually get a deal done. But if you can't, go find somebody who has it. It's,
absolutely.
It's still worth doing.
Yeah, I think there's always a way to get the deal done.
There's always a way, right? I think if you remember that and then you just go, okay, well, clearly I don't know everything I need to know. I need to go find more people and learn more. So totally. What's your goal with all this?
I think for me, so I have a family. So I have a young family, I guess getting older a little bit. So I have 3 boys. So I have 7, 9, and 11. And so my decision, I guess, 2 years ago to step back from my other business was, partially to spend more time with them, but also spend more time in the real estate and investing game. I enjoy doing this. Like I enjoy I enjoy business building. So to me, this is, I'm building a business. It's a different business and marketing research, but the same principles and aspects apply. I'm dealing with clients, I'm, dealing with building systems, et cetera. So I like the business building side of things. The end goal is to, in terms of retiring, I have to keep busy. In terms of doing this, but it just affords me the time and it gives me the financial means to do things that I like to do, which is travel, spend time with kids, go to rep hockey games because my kids are into hockey, and so I spend a lot of time with them on the road. Right now I'm fortunately to be in a place that I can do that, and have the leeway in my schedule to be able to do that.
I think that's a very common thing I hear is it's not so much do nothing, because I don't think any of us want to do nothing. That's boring.
It's boring. Totally.
But the option to do nothing, if I if I don't, or just to choose, the option to choose, is an incredible option, which I'm a big fan of. Every day, what am I going to do today? I could really grind it out and push if I want to, or I could take it easy. But that being said, I don't mind a good push.
Of course. It keeps the the mind sharp and it's I think the options. I think that to be able to decide what you want to do on your own, right, is I think key.
Okay, so what is something that you would suggest for someone to do? They wanted to get started in multi-res. What's one piece of advice you think is critical to give them?
Getting familiar with this space. One way to do that, aside from there's a few podcasts. Your podcast, talk about multifamily. There's others that talk about multifamily. So that's kind of one thing. But if people are interested in multifamily, they've probably already done that, and they've probably already read some books. So I think the next step to really, where the rubber hits the road is start analyzing deals. Right? Analyze a deal. Analyze a bunch of deals. Analyze 20 deals. It's like you're flexing this analytical muscle, right? It's like anything. You have to do things a few times to start to get a feel if it's a good or bad deal. So pick one market. Look at real deals, analyze the financials of these deals. And, the first 1, 2, 3, or 4 may feel a little foreign, but I think once you pass, get into 5, 6 plus, things start to get a little familiar. The ratios start to make sense. The price per door is like, oh yeah, well this one was, you start having your own benchmarks. I think that's a good exercise that people should, if you're serious about getting into it, whether you're passive or active, right? I think even as a passive investor, you should look at the financials and analyze deals.
Yeah, I think you're bang on with that. Getting the exposure, it's something that I do when I'm actively looking for properties. I am evaluating deals all the time.
Yeah.
I'm pulling up a property. I'm just hypothetically, what could I get? What would it cost me?
Yeah.
I've crunched the numbers. I'll do it on multifamilies, which where I've mostly been disappointed with my model. But you're giving me something to think about as to a different approach with that, the joint venture approach, which definitely opens up. Yeah, it opens up some possibility to take a little bit longer,
right,
and get a good deal, and make the deal happen. So that makes a ton of sense. So, what's one thing you would say definitely do not do for somebody thinking about getting started?
That's a good one. I think if someone's going to do not go it alone.
Okay.
I don't think you have to go alone. I mean, there's a bunch of ways to not do that. One, find someone who's done it and work with them on it. If you want to do the deal on yourself, there's a lot of mentors out there. There's a lot of people that are doing it. Request some coaching. I think that's really important.
Yeah.
So I think, the stakes are a little bit higher. There's more money on the table. This asset class is a little more stable, but because of its stability, or maybe a function of stability, is things just take longer. Yes. Right. Even if you make a mistake, it may correct itself over the long time, but it takes a long time to do that. So I think, partnering with someone that's experienced in doing doing this type of work is important, especially for, your first go. And I think, for passive investors too, look at other people that are doing it, ask a lot of questions. Yeah. And then that, and so I think because the stakes are a little bit higher, work with someone for your first deal.
Yeah, I think that goes to the same with anything. Like, make sure you got somebody with some good perspective that's essentially pulling your strings in a way, showing you the ropes and making sure that you don't make a mistake that you can't recover from.
Yeah, absolutely.
Why make that mistake when you can just leverage people in your network?
Yeah.
Maybe you have somebody that will do you a favor, like you had with your mentor there that looked over some deals for you.
Yeah, totally.
Those are all viable, and just keep asking until you find that person. Yeah, that'll help you.
And I think in our space, in the real estate space, in the circles that we're a part of, and the networking groups that we're a part of, and the events that we go to, everyone's so willing to share. Yeah. And it's not like that in all industries. Coming from the marketing space, there are people that are very willing to share, but it's also super, it's hyper competitive. Okay. And some people don't like to share the secret sauce. But I find that in this business, in the real estate business, there's more people willing to share what their secret sauce is. Yeah,
I know the exact statement. I've definitely seen it. I know people who just won't share, don't want to go to networking events because they don't want the secret to get out. But ultimately, I think that's a mistake on their part. And you might give up something, but what are you missing out on?
There's enough. There's
You're
so much.
Missing out on too much more.
Oh yeah, there's so much opportunity. There's enough for everybody.
Yeah, there is enough for everyone. It's just, it might not look like exactly what you think it would look like. Sometimes you got to learn what you don't know, and then it becomes clear. So that's awesome. So a little bit about you. What would be your dream vacation?
Oh, dream vacation. So on our kind of list, my family's list, go to, the safaris and, in South Africa would be pretty cool. India is a place, that's on the list. I'm actually heading to Australia in a couple of weeks, partly business, but then I'm taking some time just to cruise around and perhaps, meet up with a friend in Tokyo. So, again, there's options to do that, I have the time to do that, and the resources to do that. So, I know my kids really want to, so we're thinking about an East Asia trip over the next little while. Two of my kids want to do it, one does not. So we'll figure out we'll find a happy medium. One wants to go skiing and snowboarding during the winter months. So, there's a few things on our list. For us, I think fortunate enough to be able to, think about and plan and probably follow through with some of these ideas and plans. So
awesome. What's your hobby to do outside of all this real estate stuff?
Yeah. So my kids are pretty active in hockey. So I do coach one of them. So I spend a lot of time on the ice right now. So that's cool. Fishing, love fishing. My kids love fishing. So we try to get it as much as possible, camping and stuff like that. So outdoors, anything outdoors. And then during the winter season, we're at the rinks a lot.
Nice.
Yeah.
Awesome. Well, Mark, if someone wants to get a hold of you, what is the best way for them? Or if they wanted to follow you on Insta, like whatever you prefer, what's the best way to have them get in touch?
Yeah, no, appreciate it. So I'm active on Instagram. So Mark_Baltazar.
Okay.
It's pretty straightforward. Email mark@peakpropertyinvestments.ca. And again, my website is peakpropertyinvestments.ca.
Okay, so I'll put that information in the description just so that that people have that, and yeah, probably want to follow you, see what you're doing. You post some of the stuff on your real estate adventures.
Yeah, I do. I post stuff on flips. I post stuff on multifamily. I write, so I like writing. So I'm writing, a bunch of blog posts. I've started a book on multifamily, just kind of the step-by-step process. Nice. Again, demystifying it. This whole idea of just kind of pulling back the curtain and getting into things that, I think new investors should know about. So that's in the works. And so, yeah, just, like sharing information. I mean, people helped me along the way. So I just want to help and give back.
Awesome. Well, I'm sure that many people are going to appreciate that. And I certainly appreciate that too. I'm going to be sending you some messages.
Cool. Yeah. No problem.
I'm sure you got tons of perspective that we can help each other there. And I
absolutely.
Would love to do that. So awesome. Okay. Well, we'll have to have you on again sometime and see how things progress. Sure. I'll love to hear the story when this building's all fixed up.
Sure.
All right. Thanks a lot, Mark. We'll see you on the next one.
Yeah. Appreciate it. Thank you.